It's been an interesting time if you are in the travel and tourism industry, more so if you are in the boarding business, so to say. We've seen hotel companies come out with a mixed set of numbers. Mahindra Holidays is a slightly different nature of business in that sense, despite the fact that it is firmly in the bracket that I just spoke about. They came out with the Q2 numbers. Net profit on a YOY basis was down about 30%, but revenues were up about 9.5%. There was some cost pressures, I presume, that they saw both on the India side, but more so in the Finnish subsidiary and therefore the European operations. Mr. Kavinder Singh, he's the MD and CEO, Johnson right now to talk about how the quarter was and how does the second half of the year augur for them. Mr. Singh, good having you. Thanks for joining in. Hope all is well.
Thank you. And I would like to take some time to explain what the quarter two numbers, look like for us and, of course, for our investors. The good news is that our income is up by about 14%, and I'm talking about standalone, and I will talk about consolidated results as well. And the best part is that our resort income was up 34% year-on-year basis. This is due to the fact that we had 79% occupancy on an expanded base of inventory. Our inventory went up by about, room inventory went up by about 500 rooms. So on the expanded base, we had a higher occupancy from 72 to 79%. And that led to the occupied room nights going up by 27% and the income going up by 34%. So that's something that we are extremely happy about, considering the fact that October, July, August, September is typically not a seasonal quarter. And despite that, we had a 34% growth in the income on the resort side. If I were to look at our member additions, we had, we have accelerated our member additions. We closed the quarter at about 4,397 member additions. We are seeing traction in the demand for memberships. And the best part is that along with this, we had very healthy EBITDA margin at standalone level at about 28% and PBT margin at about 14%. And by the way, if you were to compare it on a like-to-like basis, YOY, last year we had some one-off, benefits that we got. There were lease rent waivers because it was, it was a pandemic time, and therefore some lease rent waivers came in. And there was the interest on income tax refund totaling to about 15 crores. So if you were to ignore that, our PBT grew by about 5% and our EBITDA grew by about 12%. And as I said, income was up by about 19%, excluding one-offs. So it's been a great quarter from that sense. And if I were to compare these margins of, EBITDA and PBT, our EBITDA margin is 500 basis points up compared to pre-pandemic levels Q2 FY20 and about 270 basis points on PBT if you were to compare with Q2 FY20, despite expanding inventory by about 1,100 rooms between Q2 FY20 to Q2 FY22. So this has been a great journey through the pandemic and beyond. And Q2 turned out to be the best ever quarter for us, both on member additions, resort incomes, and total income, and EBITDA and PAT. Now, when I come to the consolidated results, the best part for the this quarter was that we delivered, despite the situation in Europe, we delivered 70% occupancies. We delivered 1.9 million euro EBITDA in the our Finnish operations, or the Finnish, Swedish, and Spanish operations. The Finnish company has a Swedish subsidiary and a Spanish subsidiary. And so it turned out to be a great quarter, both in terms of occupancy and EBITDA. Their income, in fact, if you would exclude the one-offs, grew by about 14%. And actually, if you exclude the one-offs, their EBITDA grew by about 23%. Now, when you look at consolidated results, of course, there are some forex-related movements up and down, but that's not that important. But more important is they had one-offs of about 2.6 million euro, like we had one-offs of 15 crores. And that is why you see the PAT consolidated level lower than last year, because all that is related to one-offs and not related to operations. In fact, operations are stronger and robust more than ever if I were to compare against the Q2 of last year for both us and them.
So you are saying that the profitability lower on a YY basis is because of one-offs. Had the one-offs not been there, the profitability would have been higher, both for domestic and the Finnish subsidiary, or only for the domestic business?
Both for domestic and international. We had 15 crores one-offs, which were baked into the EBITDA and PBT. And they had about 2.6 million euros of one-offs. And that's something that when you knock that off, you really see a picture which is much brighter than what it is if you were to not reduce the one-offs. Yeah.
Okay. So in July, you had mentioned that the European business is seeing some unprecedented cost pressures. My question is, have these abated? And do you reckon that one-offs notwithstanding, your operational metrics, even on a console basis, I'm talking purely console basis, could look improved in Q3 and Q4, or is it difficult to predict that right now?
So for me, despite the headwinds that we have, I'm predicting Q3 and Q4 better than last year at consolidated level for us and them put together. Partly because reasonable amount of tightening on the cost side has already happened, and the benefits will be visible in Q3 and Q4. Both at our end, we do a bit of cost tightening anyway at our end, as well as, of course, more at their end. But the best part is that for them, Q4 is a very big seasonal quarter. So that's the winter skiing season, and that's the time they make the best possible EBITDA and EBIT, and that quarter turns out the best possible numbers. Q3 is not that seasonal for them. The season really begins from mid-December onwards. So Q3, they will do well compared to the last year. That is for sure because of the way they are set up. And Q4, they are likely to do much better than last year. So I am very confident about the next half for us and them at consolidated level and at the both companies level.
Yeah, so Q3, the India business for you steps up because it's a peak season. Q4, the subsidiary business steps up. So in the console space, you will have each contributing in some fashion. Okay. Now, there's a bit of a highlight in Q2 in that not just the occupancies, which did very well for you, I believe 79% or thereabouts, but the one which has got a slightly longer tail impact, which is the member additions, was very strong. Now tell us, I mean, is this happening completely organically without any extra discounts or spends being given in that sense? Or are you having to kind of battle it out for the member additions and therefore the IRR per member addition might be lower than the past? Can you give us some insights here?
In fact, our cost of acquisitions are lower than the past.
Okay.
Because we have structurally defined our business slightly differently. The way we reach out to the members, we use digital routes. We use the referral route. Digital and referral contribute to about 57% of our business. So we are structurally superior in terms of our cost of acquisition. And that is why I said that in Q2 FY23, which is going on, but if you were to compare it against the Q2 FY20, we have had an improvement in EBITDA margin by 500 basis points. Obviously, this improvement has come through cost of acquisition, the people-related costs, as well as the resort operations-related costs. These are the three costs in our business. So we have structurally redefined the acquisition methodology. Digital and referral is about to grow. Referral comes at a very, very low cost. We have launched a loyalty program. We came out with a campaign with Ravina Tandon during this quarter, digital campaign. So there are a lot of actions that we are initiating or have initiated, which is helping us grow margins in these difficult times, as well as grow the member additions, which I just mentioned to you.
Okay, Mr. Singh, one final question. When I speak to hotel companies, pure hotel companies, I mean, slightly different than you, but in some ways similar as well. Let's put it that way. All of them have to say that this space at large has not seen any meaningful asset additions in India, at least. And therefore, they believe that over the course of the next 2 or 3 years, whatever happens to occupancies is one thing, but the ARRs will crank up quite significantly. Now, my question is, in your case, two, there is one, the member loyalty for coming to the resorts, and two, the kind of income that you make out of the member being there. Do you reckon that as an average 12-month ARR or IRR that you make per room, per customer, as the case may be, do you reckon over the next 3 years, there is room for that number or those numbers to move up, have a step up of sorts compared to where they are right now? Other things remaining constant.
Yeah. No, I think you make a very valid observation. And as I mentioned, our business, and you also mentioned that our business is very different from a traditional hospitality player. The traditional hospitality players struggle with two areas: occupancy and debt. We are a zero debt company. Our occupancy remains above 80% round the year. So that way we are very different. Not only that, we have a cash on our books. There are not many hospitality players who have cash of the order of 1,000 crores on their books. Now, you know what it does for us is that we do only 2-3 things which keep us, becoming healthier than what we are. Number one, there is definitely a huge focus on creating new experiences, because we make good money on the F&B and the holiday activities. Families come for vacations. We are focused on family vacations. We don't focus on weddings. We don't focus on MICE. Our focus is very clearly family vacations. These are individuals with families who come with their extended families, and they spend money at the resort, and that becomes a great source of income for us. That's why I was hopping upon on the resort income, 68 crores, 34% growth YOY. To us, that's very, very valuable, because we don't charge for the room. There is a very small amount of inventory that we put it out in the market, which is unused. We have seen ARRs going up there, but that's not something that we talk about much, because it's a very small level of inventory that we do. So as far as we are concerned, for us, the inventory additions have been very robust. In the last 3 years, between Q2 FY20 to FY23, we added about 1,100 rooms. That's a very significant movement in terms of number of rooms that we added, considering our total room count is now 4,700. So our focus will remain grow the inventory. We have never stopped investing. We have never stopped looking at buying properties. We have never stopped looking at leasing. So for us, the inventory addition is critical, and so the supply will remain, in my view, comfortable for us. And as far as we are concerned, there are 2-3 levers that we will keep pressing. One is on the cost side. Second is on the income side. We would like to definitely grow our resort income. We would like to have members spend more money at the resorts. Of course, timely tactical increases in prices, particularly on the membership fee, as well as the F&B, items, there will be price increases there. So there will be price increase levers, there will be cost levers, and there will be growth levers in terms of getting more members to come in, and more members to actually spend at our resorts, and more spend per room. So all the levers are up there for us to use huge amount of data science to do this. By the way, we have a very strong data science practice, and therefore we are able to, at the right time, nudge through the app members to take these decisions. And that is actually the secret sauce that we are building behind the scenes.
So step up from where we are right now on the margin front in 3 years' time?
So margin has already expanded by about 500 basis points in the last 3 years' time.
No, but that's the standalone margin, right? You're talking about.
Yeah, the standalone margin.
I'm talking about consolidated, sir. You reckon that from where you are right now, there could be a step up?
Yeah. So the consolidated EBITDA margin is at about 23.5% at the Q2 level. And that's something that we will definitely try to push up, because the push will come from our own margin expansion, and push will also come from their margin expansion. And rightfully so. Right now, there is inflation there. So you may not see very huge improvement in their margin. Some margin will happen improvement, but not a very big improvement because of the inflationary pressures that they're going through. But having said that, the cost tightening has been done, and there will be some kickers that we'll be seeing in the console margins, even in the Q3 and Q4, as I look ahead.
Got it. Mr. Singh, all the best. Thanks so much for speaking to us today, and have a great holiday period for Mahindra Holidays and Resorts.
Thank you so much.
Yeah, lovely talking. Viewers, thanks for tuning into this conversation.
Bye-bye.